Have you ever wondered why some people end up owing thousands in taxes, even though they thought they did everything right? What if I told you that a few small, common mistakes could quietly drain your wallet when filing your taxes? Stay with me, because by the end of this video, you'll know how to keep that from happening, and maybe even save yourself a serious headache next tax season. Number 1. Forgetting to report all income. One of the biggest mistakes people make is leaving out income. It might sound harmless, but it can raise a red flag with the IRS. For example, let's say you drove for a rideshare app or freelanced on the side. You might get a Form 1099 from that gig, but sometimes people forget to include it. The IRS, however, gets a copy of that form too. So if your tax return doesn't match what they have, they'll notice. Even money from things like online sales, investment dividends, or bank interest counts as income. Whether it's $50 or $5,000, it needs to be reported. Missing it could mean penalties, interest, or even an audit. A simple way to avoid this: gather all your tax documents before you start: W-2s, 1099s, interest statements, everything. Double check that you're not missing any. Number 2. Filing with the wrong status. Your filing status determines how much tax you owe and what credits you qualify for. Choose the wrong one, and you could either overpay or underpay. For instance, if you're single but also support a child, you might qualify as head of household, which usually gives you a bigger standard deduction. But many people accidentally select single because it seems simpler. Another example: married couples sometimes file separately thinking it'll save them money. But most of the time, married filing jointly results in lower taxes and more credits. If you're unsure, use the IRS's online tool to check your correct status. It's quick and can make a big difference in your refund. Number 3. Not taking advantage of all deductions and credits. This is where a lot of beginners lose out on money they could have saved. A deduction reduces your taxable income, while a credit directly reduces how much tax you owe. For example, the Earned Income Tax Credit helps low to moderate income earners get back hundreds or even thousands of dollars. Many people skip it simply because they don't know they qualify. Or take education-related credits like the American Opportunity Credit or Lifetime Learning Credit. If you or your child are in college, that's real cash back you don't want to miss. Even small deductions, like student loan interest, medical expenses, or charitable donations, can add up quickly. Here's the trick: keep good records. Save receipts and track expenses during the year. You don't want to be scrambling at the last minute, trying to remember if that textbook or that doctor's visit counts. Number 4. Filing too late. We've all been there, thinking we have plenty of time until the deadline suddenly sneaks up. But late filing can cost you money in penalties and interest. The IRS penalty for filing late is usually 5% of the unpaid taxes for each month you're late, up to 25% total. That's a painful lesson to learn the hard way. If you know you can't file on time, submit Form 4868 for an extension. It gives you 6 extra months to file. But remember, an extension to file is not an extension to pay. You still need to pay what you owe by the original deadline to avoid extra charges. The earlier you file, the faster you get your refund, and the less stress you deal with. Number 5. Entering wrong numbers or missing information. This one sounds simple, but it happens more often than you'd think. A single typo can delay your refund or even trigger a letter from the IRS. Maybe you swapped 2 digits in your Social Security number or accidentally typed the wrong bank account for direct deposit. Before you hit submit, go over every detail carefully. Double-check your Social Security numbers, your dependents info, and your routing numbers. It's like proofreading a job application. You want 0 mistakes. A little attention to detail can save you weeks of waiting for your refund. Number 6. Not signing the return. Believe it or not, thousands of people forget to sign their tax return every year. If it's unsigned, the IRS won't even process it. It's as if you never filed at all. If you're filing electronically, make sure you finish the e-signature step. If you're mailing it in, don't forget to sign both pages if required. It's the simplest fix to a frustrating problem, yet so many people miss it in the rush to get it done. Number 7. Ignoring taxable side hustles. In today's world, almost everyone has a side hustle. Maybe you deliver food on weekends, sell handmade crafts online, or rent out a room in your house. But here's the catch. Many people don't realize that income from side gigs is taxable. For example, if you make over $600 from a gig platform, they'll send you a 1099 form. But even if they don't, you're still required to report that income. And don't forget, you can also deduct related expenses like gas, supplies, or a portion of your home office, if it's for business use. So while you might owe some taxes on side hustle money, smart record keeping can help offset it. Number 8. Overlooking retirement contributions. If you contribute to a retirement account, like a traditional IRA or a 401k, you can lower your taxable income and save for the future at the same time. But here's the mistake. Many people forget to include their contributions or don't take full advantage of them. For example, if you're under 50, you can contribute up to $7,000 a year to an IRA, depending on your income. Those contributions might be tax deductible. If your employer offers a 401k, that's even better. Some companies match your contributions, which is like free money for your retirement. By missing out, you're not just paying more in taxes today, you're losing future growth that could have compounded over decades. Number 9. Forgetting to update withholding. Your withholding is how much your employer takes out of your paycheck for taxes. If it's off, you might end up owing a big chunk next April, or get a tiny refund when you expected a large one. Let's say you started a second job, or your spouse began working too. Suddenly, your combined income is higher, but your withholding hasn't changed. That means less tax is being taken out during the year. To fix it, use the IRS tax withholding estimator online. It's free and only takes a few minutes. You'll know exactly how much to adjust so you're not caught off guard later. Number 10. Missing the standard versus itemized deduction choice. Most Americans take the standard deduction. It's simple and usually saves time. But for some people, itemizing could save more money. If you own a home, have large medical bills, or give a lot to charity, itemizing might lower your taxes further. For instance, the standard deduction for single filers in 2025 is $14,600. But if your itemized deductions add up to more than that, itemizing wins. If not, the standard deduction is your best bet. It's automatic and requires no extra proof. The key is to calculate both and see which one benefits you more. Number 11. Throwing away tax documents too early. After filing, many people toss their papers in the trash or delete old emails. Big mistake. The IRS recommends keeping your tax records for at least 3 years. Why? Because if the IRS audits you, you'll need to show proof of income and deductions. And if you underreported income by more than 25%, they can go back 6 years. So, organize your tax documents in a folder, digital or physical, and label it clearly by year. You'll thank yourself later if any issue comes up. Number 12. Falling for tax scams. This one's scary. Every year, scammers pretend to be from the IRS, calling, texting, or emailing people demanding money or personal info. The IRS will never call or text you first. They send official letters by mail. If you ever get a threatening message, do not respond. Go directly to the IRS website to verify your status. Scammers often use fear to make people act fast, but staying calm and informed protects your wallet and identity. Number 13. Not reviewing your return before submitting. Think of your tax return like a final exam. You wouldn't turn in your test without checking your answers, right? Before you hit File, review every section carefully. Make sure your personal details, income, deductions, and credits are accurate. Tax software can help, but it's not perfect. It's still up to you to verify everything. Taking 10 extra minutes to review can prevent months of dealing with corrections later. Number 14. Ignoring state taxes. Many beginners focus only on their federal taxes and forget that most states have their own tax systems. If you moved to another state, worked remotely for a company in a different one, or earned income in multiple states, you might owe taxes in more than one place. For example, if you live in Florida but work for a company based in New York may still require you to file a state return. Not filing your state taxes can lead to penalties, interest, and even collection notices. Always check your state's tax website or use tax software that automatically calculates both federal and state obligations to stay compliant. Number 15. Ignoring healthcare reporting. If you bought health insurance through the marketplace, you'll receive Form 1095-A. This form helps you reconcile your premium tax credits, money that help lower your monthly insurance payments. If you forget to include it, your return might be delayed, or you could owe back some of the credit. It's important to compare your 1095 a form to what you entered on your tax return. Even small errors can change your refund or balance due. Number 16. Forgetting about estimated tax payments. If you're self-employed, a freelancer, or have investment income, you might need to make quarterly estimated tax payments. Many beginners forget this step, thinking they can just pay once a year. But the IRS expects you to pay taxes as you earn income. Skipping these quarterly payments can lead to underpayment penalties. A good tip is to set aside a percentage of every payment you receive and use the IRS direct pay system to make your estimated payments on time. Number 17. Mixing business and personal expenses. If you run a small business or have freelance income, separating your business and personal expenses is crucial. Many people use one bank account for everything, which makes tax time a nightmare. You might accidentally deduct personal purchases, which the IRS doesn't allow, or miss real business deductions. Keep a separate business account and card. That way, you can easily track income and expenses when it's time to file. This simple step makes your taxes cleaner and safer. Number 18. Overlooking tax implications of big life changes. Major life events, like getting married, having a child, buying a home, or retiring, can all change your tax situation. For example, having a baby might qualify you for the child tax credit. Buying a home could mean mortgage interest deductions. Getting married might shift your tax bracket or change your withholding. Each change comes with new paperwork and potential benefits or obligations. Updating your tax information after these milestones ensures you're not missing out on deductions or overpaying taxes. Number 19. Not reporting cryptocurrency transactions. Many beginners think crypto profits are off the grid. They're not. The IRS considers cryptocurrency property, meaning profits from selling, trading, or even converting coins to cash must be reported. If you made $200 from selling Bitcoin or $500 from trading Ethereum, those are taxable events. Exchanges often report your transactions to the IRS, so hiding them can lead to penalties or audits. Keep detailed records of every crypto transaction, including purchase price, sale price, and dates. Number 20. Claiming dependents incorrectly. Claiming someone as a dependent can save you hundreds or even thousands in taxes. But if more than one person claims the same dependent, say, both parents after a divorce, the IRS will flag it. Make sure you meet all the dependency tests: relationship, residency, age, and financial support. For instance, if your child lived with you for most of the year and you provided more than half their support, you can likely claim them. If not, the IRS might disallow the claim and require you to amend your return. Number 21. Ignoring changes in tax laws. Tax laws change more often than people realize. Credits, deductions, and income thresholds can shift every year. For example, the standard deduction amount typically increases annually for inflation. Failing to stay updated means you might miss out on new credits or continue claiming outdated ones. Using updated tax software or following IRS news releases can help you stay ahead of any changes. Number 22. Forgetting about refundable versus non-refundable credits. Not all tax credits work the same way. A refundable credit gives you money even if you owe nothing in taxes. For example, the Earned Income Tax Credit can give you a refund beyond what you paid. A non-refundable credit, on the other hand, only reduces your tax bill to zero. You won't get money back from it. Knowing the difference helps you plan better and understand why your refund is smaller or larger than expected. Number 23. Not using direct deposit for refunds. If you're expecting a refund, choosing direct deposit is faster, safer, and more reliable than waiting for a check in the mail. Many people still pick the paper check option, which can take weeks longer and even get lost. By entering your correct routing and account number, you'll usually get your refund within 21 days. Just make sure the account is in your name and double-check the numbers before submitting. Number 24. Forgetting to file when you're below the income threshold. Even if you earn below the minimum income required to file, it can still be smart to file a return. Why? because you might qualify for refundable credits like the Earned Income Credit or get a refund for withheld taxes. Many low-income earners skip filing, leaving free money on the table. Filing even a simple return ensures you get what you're owed. Number 25. Using the wrong tax form. Filing the wrong tax form can cause delays or errors in processing. For example, if you're self-employed, you need to use Schedule C to report your business income. If you're claiming itemized deductions, you'll need Schedule A. Using the standard 1040 alone when you have extra forms can mean missing deductions or misreporting income. Most tax software automatically selects the right forms for you. But if you're filing manually, read the instructions carefully. Filing taxes doesn't have to be stressful or confusing. Most of these mistakes come from rushing or guessing. If you take your time, stay organized, and double-check your info, you'll file confidently and possibly save more than you expect. So, here's my question for you. Which of these tax mistakes have you seen people make the most? And which one do you think you might have made before?